Investing in stocks is one of the most powerful ways to build long-term wealth. Yet for many beginners, it feels confusing, risky, and overwhelming. The truth is, you don't need to be a financial expert or have a huge amount of money to get started. With the right knowledge, mindset, and strategy, anyone can begin investing in the stock market and steadily grow their wealth over time. This guide is designed to walk you through everything you need to know, from understanding what stocks are to building your first portfolio, so you can start investing with confidence and clarity. Today, we will talk about how to invest in stocks for beginners. Full guide. So, before we start, make sure to hit the like button and subscribe to my channel. At its core, a stock represents ownership in a company. When you buy a stock, you are essentially purchasing a small piece of that business. If the company performs well, grows its profits, and expands its operations, the value of your stock can increase. Additionally, some companies pay dividends, which are regular payments made to shareholders from the company's profits. This means you can earn money in two ways, through price appreciation and dividend income. Before you jump into investing, it is important to understand why people invest in stocks. The main goal is to grow wealth over time and beat inflation. Simply saving money in a bank account often isn't enough because inflation reduces purchasing power. Stocks, on the other hand, have historically provided higher returns compared to traditional savings methods. However, with higher returns comes higher risk, so it's essential to approach investing with a clear plan. The first step in your investing journey is setting your financial goals. Ask yourself why you want to invest. Are you saving for retirement, buying a house, building passive income, or achieving financial independence? Your goals will determine your investment strategy, time horizon, and risk tolerance. For example, if you're investing for long-term goals like retirement, you can afford to take more risks compared to short-term goals. Once you have defined your goals, the next step is understanding your risk tolerance. Risk tolerance refers to how much volatility or loss you can handle emotionally and financially. Stock markets can go up and down, sometimes sharply. Beginners often panic and sell during downturns, which leads to losses. Knowing your risk tolerance helps you stay calm and stick to your plan during market fluctuations. After that, you need to open a brokerage account. A brokerage account is a platform that allows you to buy and sell stocks. There are many online brokers available today that make investing easy, even for beginners. When choosing a broker, consider factors like fees, user interface, available research tools, and customer support. Many platforms now offer zero-commission trading, which makes it more affordable to start investing. Once your account is set up, it's time to fund it. You don't need a large amount of money to begin. Many platforms allow you to start with as little as $10 or even less. The key is consistency. Investing small amounts regularly over time can grow into a significant sum due to the power of compounding. Compounding means earning returns on your previous returns, which accelerates wealth growth over time. Now comes one of the most important parts: understanding how to choose stocks. Beginners often make the mistake of picking random stocks based on hype or social media trends. Instead, you should focus on companies with strong fundamentals. This includes looking at their revenue, profit, debt levels, and growth potential. Companies with consistent earnings, strong management, and a competitive advantage are generally considered good investments. Another strategy for beginners is investing in index funds or exchange-traded funds, ETFs. These funds track a group of stocks, such as the overall market or a specific sector. Instead of picking individual stocks, you invest in a diversified portfolio with a single purchase. This reduces risk and is often recommended for beginners because it requires less research and provides stable returns over time. Diversification is a key principle in investing. It means spreading your money across different assets, industries, and companies to reduce risk. If one investment performs poorly, others may perform well, balancing your overall portfolio. Beginners should avoid putting all their money into a single stock, no matter how promising it seems. It is also important to understand the difference between long-term investing and short-term trading. Long-term investing involves holding stocks for years or even decades, allowing your investments to grow steadily. Short-term trading, on the other hand, involves frequent buying and selling to take advantage of market movements. For beginners, long-term investing is generally safer and more effective because it reduces the impact of short-term volatility and emotional decisions. One of the biggest advantages you have as a beginner is time. The earlier you start investing, the more you benefit from compounding. Even small investments can grow significantly over decades. This is why it's better to start early rather than waiting until you have a large amount of money. Another important concept is dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of market conditions. When prices are low, you buy more shares. When prices are high, you buy fewer shares. Over time, this helps reduce the impact of market volatility and lowers your average cost per share. Emotions play a major role in investing, and controlling them is crucial for success. Fear and greed are the two biggest enemies of investors. Fear can cause you to sell during market crashes, while greed can lead you to chase risky investments. Successful investors stay disciplined, stick to their strategy, and avoid making impulsive decisions based on short-term market movements. You should also pay attention to fees and taxes. Even small fees can add up over time and reduce your returns. Look for low-cost investment options and understand the tax implications of your investments. In many countries, long-term investments are taxed at a lower rate than short-term gains, which is another reason to focus on long-term investing. As you gain experience, you can start learning more advanced concepts like technical analysis and fundamental analysis. Fundamental analysis involves evaluating a company's financial health, while technical analysis focuses on price patterns and trends. However, beginners should not feel pressured to master these immediately. Start simple and gradually build your knowledge. It's also a good idea to keep learning and staying updated. The stock market is constantly evolving, and new opportunities and risks emerge over time. Read books, watch educational videos, follow reliable financial news, and learn from experienced investors. The more you educate yourself, the better decisions you will make. One common mistake beginners make is trying to time the market. This means attempting to buy at the lowest price and sell at the highest price. Even experienced investors struggle with this. Instead of timing the market, focus on time in the market. Staying invested for the long term is more important than trying to predict short-term movements. Patience is one of the most valuable traits in investing. Building wealth through stocks takes time, and there will be ups and downs along the way. Avoid expecting quick profits or overnight success. Consistency, discipline, and patience are the keys to long-term success. Another important tip is to review your portfolio periodically. This doesn't mean checking it every day, but rather evaluating your investments every few months or once a year. Make sure your portfolio aligns with your goals and risk tolerance. Rebalance if necessary by adjusting your investments to maintain the desired allocation. Finally, remember that investing is a journey, not a one-time activity. Your strategy may evolve as your financial situation, goals, and knowledge change. Stay flexible, keep learning, and continue improving your approach over time. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.